Hello and welcome. I'm Amritan Shirai and you're watching Law of the Land on Sabha TV. Today we bring to you the Microfinance Institution Bill 2012, which proposes to develop and regulate the microfinance business. To discuss the issue, I have with me Mr. Matthew Titus, Executive Director, Sadhan, and Mr. Ramesh Kumar, CMD, Swarn Pragati Housing Microfinance. Now for the headlines. The bill proposes better liquidity to poor borrowers through microfinance, but with regulations. The bill creates district microfinance committees and empowers them to audit finances. And it mandates the creation of State Council, which will have to report to the Reserve Bank of India periodically. The Microfinance Institutions Development and Regulation Bill 2012 seeks to provide a legal framework so that liquidity to the poor borrower is made available without him being exploited by the lending agency. As of now, lending to the most deprived section of society is happening at a very high interest rate and is not regulated.
The Andhra Pradesh government recently shut down the operations of 50 branches of established microfinance institutions. They were shut down following allegations of charging unreasonable interest rates and forcing loans on borrowers. The crisis highlighted the absence of any legislation to regulate and monitor microfinancing institutions (MFI). The proposed bill creates a legal framework to develop and regulate microfinance sector.
I think the net own funds cap at 5 lakhs is way too low because it is not an effective entry barrier. In Andhra, the issue has been that there were many money lenders who have started posing as microfinance institutions. Okay, so now even these people can still operate in the system.
The bill defines microfinance institution (MFI) as an institution registered under Societies Registration Act, Companies Act, or any other organization specified by the Reserve Bank of India. The bill also defines the financial activities of microfinancing company and restricts the lending amount to 5 lakh rupees per individual. For special purposes, microfinance institution (MFI) can extend individual lending to 10 lakh rupees but will have to take approval from Reserve Bank of India. As per the bill, MFI can collect deposits and provide pension or insurance services. The MFI can practice money transfer services to individuals within India subject to prior approval of the Reserve Bank. The bill proposes to set up a Microfinance Development Council to advise the central government in formulating policies for developing microfinance sector. The council may make legislation and suggestion on adopting innovative technology and creation of Credit Information Bureau for creation of database of clients availing microfinancing services. Council will also be responsible to monitor the functioning of the grievance redressal mechanisms. The council will be headed by a chairperson and 4 members who have experience in banking and financing sector.
I think that the aspect of the quality of the loan which has been provided to the people through the microfinance should have been the part of this bill, because in the previous cases it was found that it was the quality of the loans which were very poor, that resulted in the fallouts in the microfinance development in India. So I think that should have been added within that.
The microfinance institutions are often accused of charging excessive rates of interest, resorting to unethical ways of recovering loans by using intimidation and abusive language, combining multiple products like savings and insurance. The major problems in the MFI sector came into limelight when the Andhra Pradesh MFI sector witnessed 7,200 rupees crores loss in the MFI sector. The government passed an ordinance to curb these kind of activities. Now the central legislation will definitely kind of oversee the AP's legislation. There, on that front, government is going to face some kind of opposition. Rajkamal Rao, Rajya Sabha TV.
The microfinance sector does not have any legal framework for it to operate as of now. My question to you, Mr. Matthew Titus, is, first of all, forcing loans on borrowers, high interest rate. Does this bill address these two issues? The possibility of the microfinance lender at the grassroots not doing these two things. Does it prevent?
And I think there are two differences as opposed to the previous bill. The first is that the present bill defines aspects of what constitute even interest rates. And I think it's very rigorous and robust, even as opposed to the previous draft that was there. And it includes all forms of charges that have been arguably not put into what is called the interest rate calculation. So I think it's definitely there. And not only that, you also have two levels of supervision. One is at the level of the district and one is at the level of the state. Both of which should, between themselves, ensure that the quality of supervision and the quality of data that is there should restrict any issue about high interest rates.
Do you think it's implementable? Because if we take away, if there is heavy regulation, and if you want to be inclusive, and if you don't give dynamism to the lender at the grassroots, do you think it's as easy as said in the bill?
Yeah, to answer this, I think we just have to slightly go back to see the origin of the microfinance movement in India. Microfinance has been introduced in India in the probably 2 decades back, starting with the original SHG bank lending program. And along the way, the private sector microfinance institutions joined in. Earlier, it was only the development institutions, NGOs, who were doing the nursing and the
Nurturing of the entire sector.
But along the way, as the size grew, the size of the market grew, a lot of players came in. There were investors who were looking at returns on investment being adequate, commensurate with the risk. Certain distortions emerged, and we have seen all of that. So it is clear that self-regulation is not adequate anymore.
Right.
So an external regulation is necessary. Now, how intensive would that regulation be is the question. Basically, there are 2 types of regulation. One is the prudential regulation, one is the non-prudential regulation. In this bill also, and I hope in the subsequent rules also, RBI would ensure that the non-prudential regulations are the predominant regulation, and the prudential regulations are kept only applicable to the systemically important institutions, whose failures would make a systemic impact.
Right.
Most of the institutions, the MFIs, would not be systemically important. So a non-prudential regulation which looks at transparency, governance, fair practices, fair treatment of clients, I think these are the areas to focus upon, and I think this bill will address that, subject to certain handicaps.
Mr. Titus, the entire purpose of this bill, I mean, inclusion of the deprived section with a social outlook. Does this bill actually ensure that, or does it completely transform the sector into any other profit-generating sector?
I think we first need to recognize that client protection or servicing these clients, either ways, are extremely challenging issues. We are not the first kids on the block.
Yeah.
We have had the cooperatives, which the government established, and then the regional rural banks, right? It's in the failure of these institutions that the microfinance and the community development finance movement has emerged, right? So to recognize that clearly it's not only the customer service quality that's important, but also the access to such services that is equally important, right? Now, having said that, I think both these 2 areas are uncharted territory. We have not had large-scale inclusion of the poor in any part of our service economy.
Right.
Right? Now, we are the first movers really into this. Right? The rest are going to free ride on us, whether it's going to be insurance, whether it's going to be money
Pension,
remittance, pension, even agriculture goods have been failing, all of that have been. So clearly, it's going to be difficult. So having said that, I think these are first steps that are being taken in that direction.
On that note, it's time for us to head into a break. When we come back, we will talk about the powers of the district microfinance committees and state microfinance council. Welcome back. The bill proposes setting up of district microfinance committees and state microfinance council to regulate and develop microfinance business. The district committee will monitor the indebtedness of the institution. The state council will be responsible for reporting periodically to the Reserve Bank of India.
A sudden mishap with the microfinance institution in rural areas impact the lives of poor people, as it recently happened in Andhra Pradesh. Following the incident, the government now intends to set up a preventive measure at the district level. The bill proposes financial audit of all microfinancing institutions by the district microfinance committees. The committees will also be responsible to review the growth and development of microfinancing activities and monitor over-indebtedness of these institutions. The district level committees will report to the State Microfinance Council, and the State Council will submit quarterly report to Reserve Bank of India.
What is seems to be problematic here is that there are a lot of committees out there, from state council to district committee to RBI, and a lot of power had been entrusted to them, but there is an overlapping in their responsibilities and roles, which might lead to a lot of problems during the implementation of the scheme.
It also defines clearly what kind of institutions, right, structures are eligible to be an NBFC MFI. It gives a lot of clarity here, which is very important. Third, I think, is that it has also expanded the limit. Earlier it was 50,000. It is now limit has been raised to 5 and up to 10, which the RBI can solely decide. Okay, so this gives us enough leverage, and RBI it's flexible because RBI can revise as we progress.
The bill makes registration of microfinance institutions MFI by the Reserve Bank of India mandatory. RBI may clarify a microfinancing institution only when it is convinced that the general character or management of microfinance institution is not harmful to the interest of the clients. The RBI will also have to ensure that the net owned fund of the entity is at least 5 lakh rupees. If the institution fails to comply with the conditions, it will be disqualified for certification. The RBI will also fix the margin amount to be collected by the microfinancial institutions, and no institution will be allowed to collect a margin in excess of the prescribed limit. Reserve Bank of India will be empowered to appoint inspectors at all levels, and in a situation the inspector detects any violation, he can cease and desist order with 60 days of such inspection. The bill restricts MFIs to close their activities without the permission of Reserve Bank of India. Even the restructuring of an institution will have to be approved from RBI.
The spread which is being given to the microfinance institution, which is being kept at 12%. And for MFIs, raw material comes from banks. We borrow from banks. And in the current scenario, banks are lending at 16-17%. And we are being kept by 26%. So at least this is a question of survival for the microfinance institution in long run.
The proposed law sets up a microfinance development fund. The fund will ensure research and development activities in the field of microfinancing. The fund may also be used to provide loans, grants, and seed capital to provide training to those who work as inspectors. The two major problems at the ground level of MFI sector is, one is there is no definition and there is no certain guidelines to lend the money, and the process of debt recovery was always cautious. The proposed legislation actually restricts multiple lending, which will definitely strengthen the sector at the grassroots level. Rajkamal Rao, Rajya Sabha TV.
The Malegaon committee nominated by RBI expressed concern over the cap increase from 50,000 to 5 lakh rupees, as the amount may be clubbed with personal loans under microfinance. That's fine, but the question to you, Mr. Ramesh Kumar, is the high interest rates that are charged by banks.
Yes.
Part of operating model, which increases the agency, lending agency's role and increases its returns. So obviously the eventual lending is at a far higher rate. Do you think that is where one interference is required and the bill is silent on that? Do you think so?
Very right. If we need to control the ultimate lending rates by the MFIs, this can only be done by cost reduction. You cannot wish away or regulate away the high cost of intervention and inclusion in the microfinance sector. So if you cannot do that, the only solution to cap rates at a reasonable level is reduction of costs. So the Reserve Bank of India, as the appointed regulator, I think will need to really focus on how the cost reductions will happen. Partly it will be through efficiencies, use of ITs, use of mobile technology, other technologies to reach out to the poor at a lower cost, to the clients at a lower cost. But all the same, it is also necessary that the borrowing costs of the MFIs are also kept reasonably capped, so that controlled, and then only this would really be feasible, while ensuring that the access doesn't get reduced or constricted by this interest rate cap. The sustainability of the MFIs are also ensured. So I think that is necessary.
Mr. Titus, you would like to add on that two aspects. High interest rates, the borrower gets higher interest rates because the cost is high of reaching out. Now, these two interventions, if you get it at a low interest rate, obviously the end user benefits. Does the bill anywhere, even if the rules have to allow this or have to talk about this, it has to draw from the bill. Does the bill permit such operational modeling or remodeling, even if the rules are to be published by the RBI?
Unlike in any other country, we do not have large-scale donor funds. We do not get large-scale World Bank money. 95% of all the money that comes into microfinance comes from our own commercial markets. It's very different in any other country, where typical multilateral institutions establish large sources of funding. So the pricing of that is much lower. Our pricing is variable and depends on what's happening in Bombay. So the central bank, which is the RBI, has a very important role to play. And I think the RBI has played that role in the past few months and has brought out already many of the rules and the details that will be incorporated almost into the bill. So the pricing structure, the margin, all of that has already been done by the RBI. Okay. And I think that they are not only taken those into account, but they're also looking into the future and have built more mechanisms that will enable both the State Council and the District Council to become efficient.
I'll come. Role of inspector. That's another empowerment that RBI will be. I mean, the inspector has been empowered to cease and desist, which essentially means there are going to be several microfinance, several inspectors, and all moving in every direction with a territory. And that is where the execution power lies. Do you think the role needs to be revised, revisited, or there needs to be some sort of a monitoring mechanism of the inspector?
I think this is a very sensitive point, very critical. The other point in this is that, unfortunately, in this bill, there are two clauses which are somewhat draconian, Section 35 and 36, where not only for some defaults, and it's not very clear, it could even be defaults which are not willful, but which just happened because of various negligence or certain other factors. Not only are there other punitive measures, monetary penalties, etc., it talks about imprisonment for 2 years. No regulatory law anywhere else, in any other thing, in the financial sector in India, imposes imprisonment as a penalty for an economic activity where some failure has happened. I think this is again an area where an Inspector Raj could become dangerous. I think this needs to be balanced.
On that note, it's time for us to head into a break. When we come back, we'll show you an interview with CEO of MCRIT. Welcome back. My colleague Rajkamal Rao spoke to Mr. Alok Misra, CEO MCRIT, and tried to get his point on the issue and the map.
So what is the existing status of the microfinance sector? Is it financially viable, or after the AP crisis, it has gone down?
Post AP crisis, the portfolios have shrunk because 80% of the liabilities of MFIs in India was from bank funding, and banks have still not opened their purse, except one or two, like maybe SIDBI would have lent a few amounts to other things. So portfolio have hugely shrunk. MFIs are finding it tough to operate because most of them have still not gone for layoffs and all that. So the operating cost remains the same. Interest rate cap is already in place. Portfolio is shrinking. That means the operating expense ratio is going higher. So profitability is taking a hit.
Alok, so you have gone through the bill. What are your first impressions on the bill?
I find the legislation a bit forward-looking because it doesn't define microfinance, it doesn't limit microfinance to microcredit. It talks about thrift, it talks about insurance, it talks about pension, it talks about remittance services, the whole gamut of financial services. So I find it forward-looking.
The bill talks about 3-layer structure, district level, state level and central level. What is your take on the 3-layer structures?
So who is going to monitor what? It is going to create a very labyrinthine bureaucratic structure. And we already know that even in banking sector, coming from banking sector, I know that even at now in district level for the mainstream banks, there are so many committees, there's the DLCC, DLRC and all those things. It only adds to a lot of paperwork. There's not much of real work which is going on.
The bill sets out a cap between 50,000 and 5 lakh. There has been a lot of chaos on this front. So RBI can actually revise it on time-to-time basis. So what are your first opinions on this thing?
I think people are reading too much into it because the bill says very clearly that as the limit specified by Reserve Bank of India from time to time. So the current limit we all know that it is that stands. And because that in case of future growth and future inflation coming down the line, if Reserve Bank wants to hike up the limit or something like that, the legislation should not come as a barrier and they would not have to go again to make changes in the statute per se. This enabling provision has been made and I think I don't see anything wrong in that.
In spite of growth, many of the poor households still do not have access to basic financial services such as savings, credit and remittances, and this bill proposes to ensure they are included. Now, the point that you were making on the weaknesses of the bill.
Yes. While the bill is a very essential introduction at this stage, and this act is necessary, regulation is necessary, everyone will benefit from regulation, both the MFIs, the clients, the lending institutions and the society in general. But there are certain areas which have not been addressed, which possibly would need to be looked at. Does RBI have the bandwidth to administer the MFI sector? And if it has to do it through other multiple organizations, does it dilute the quality of the supervision? That is one. The second is that there is a lack of emphasis on another program, a successful program which has been running for the last 2 decades, the SHG bank linkage program, and how that is being administered and how that can be strengthened, and whether the quality of the SHG lending through microfinance lending through the bank programs, how is it being done? It has been left to the banks. And when you say it has been left to the banks, while the policy level they may be very keen and intense, the village branch manager level is where it fails or there are weaknesses found. So there is no monitoring mechanism for this. Maybe the state councils and the district committees would also need to look at this. Maybe that has to be brought within
Mr. Titus, you would like to add to that?
Yeah.
And bring out the strengths and the weaknesses?
Right. So I think some of the discussion on the supervision has been brought out in the Malegaon committee report. And under that, it's envisaged that it's banks who are lending into particular areas. So it's not only the bank and their office in Bombay which is going to be responsible, but it's bank branches which are lending into, say, Madhya Pradesh or Satara district, who will be held responsible for the quality of the portfolio in that area. And should there be any problems, they will be brought to issue. The second is, there are 4 pillars that are envisaged in the Malegaon committee. So the banks are another one. The other is the role of associations. Most associations are now picking up data which is district-wise. That data will be analyzed on a continuous basis to examine for any flaws or weaknesses that might exist even within districts. Our assumption is that that data itself will be the basis of more informed supervision by the district councils and the state councils. So basically, these are 2 elements. Along with this, there are the existing set of rating reports. So now you have MCRIL, you have CRISIL, you have ICRA, who are anyway going to be doing portfolio supervision.
Yes.
So we'll have 4 sets of data that will be available
For an assessment.
For an assessment.
Right.
So clearly some of these supervisory issues will be dealt with. There is definitely the challenge of improving the quality of supervision. But there are ways to do that, and I'm sure the central bank and the RBI will be looking at those issues. Two other points. One is we are actually not recognizing another emerging change that has followed this, which is the work around the credit bureaus. The credit bureaus are already populated with close to 10 million clients' data, right? That will kind of begin the search for multiple lending. It's not yet perfect, lots more work needs to be done. The associations have to do much more education and adoptional work to ensure these bureaus are successful. But that work has already started, and so household level data on indebtedness is beginning to be addressed and understood. So I think that's going to be an important part. On the bill itself, there's another crucial service which unfortunately on the credit side we have forgotten or we have not dealt with. That is remittance. There are 100 million people in this country on the move every month for some economic survival and some economic activity. They require money remittance services. Today you can travel on trains and you have professional people traveling with actually real cash between Bombay and Eastern UP, between different parts of the country, Surat to Orissa. You know, you have the corridors of migrants. We need to provide them the benefits of basic technology, and being the technology giant that we are, it will be shameful if we cannot provide 100 million citizens good remittance services in this country. So when we're talking of microfinance, let's not ensure that the credit part of our work overwhelms the discussion on remittance and insurance, which are other key areas that we also need to provide services.
Yes, your
to the
last
poor.
word, Mr. Ramesh. And quickly.
There is one other important area, that is the setting up of a fund for microfinance development and equity. Of course, it is being done administered by RBI. It would probably be better if an independent agency does it. Second, that this fund should also very specifically be given the responsibility of capacity building.
Yeah.
And third, the RBI's expenditure being taken away from this fund, I think that is not a very welcome step.
Thank you, sir, for joining us on this discussion. It's time for us to end the show. You can email your suggestions and comments to law.rstv@gmail.com. You can also watch our shows on the YouTube. We'll be back with a new issue and a new episode. Keep watching Rajya Sabha TV.